going to talk a little bit about investing. And these are just terms that I actually just want you to, they're in your book, read them, Google them, know them. As you enter the world of investing, it's helpful for you because they use these terms and they're really not difficult. And that's why I hope that we get to continue to meet and talk as a group offline, because we'll be able to give you analogies that simplify these terms that make it feel less, daunting. So understanding your investment options, because here's the deal. You can decide, and we talked about this a little bit. You have typically 3 options when it comes to investing outside of your IRA. You can pay a professional, be like, this is way too much, it's overwhelming, you do it, and I'll share my profits with you. So you can do that. You can say, I want to kind of learn this on my own, but I want to be coached through it. And so usually a financial advisor are typically going to get a fee plus commission. So that means they get a fee for their services and they get a portion of your investment. But it's an incentive too. The upside, it's an incentive for them to invest well for you because they're going to get cut. So, there's pros and cons. And you can start there, use a financial advisor while you're learning, and then you can kind of wean off of them. So I'm always a fan of do something rather than nothing. The other option is you can use a coach or an educator, and then typically you're only paying a fee. They're not getting a commission on the money that you earn. So they're guiding you, you're doing the stuff on your own, but they're helping you along the way. So it's not as daunting. Or go to YouTube University. There are 2 platforms out there. This is being videotaped and put on social media, so I'm not going to say the names because they're not paying us to promote them. But there are 2 platforms out there that is free, have excellent videos where you can learn. I tell people, go on a financial date with yourself and say every Saturday morning from 8 to 9 a.m. I'm going to do this thing. I'm going to just sit and learn. So it's really easy. You can go on YouTube, you can Google. There's just so many resources out there that you can do it on your own if you don't want to share your profits with anyone or pay a fee. So understanding individual stocks, basically what we've been talking here. I buy Starbucks, I'm investing in Starbucks. I buy Nike, I'm investing in Nike. I buy Coach, I'm going to invest in Coach. Individual stock. We talked about the young girl who did it, watching her friends. Or you can do the S&P 500. So the S&P 500 basically takes the largest companies that are excelling based on market size. We say sector balance, it means things like a balance of, I might be in, utilities or gold or real estate. So it's different sectors in which you buy stuff. So you even think about, look at your budget. Your budget are different sectors. So they take the top 500 performing. There's a body of people who make decisions about who's in the top 500 and basically invest in those companies for you. So when you pick, I want to put X amount of dollars in S&P 500, then you're riding with those people who are making those decisions about what companies are doing the best in that market. Those companies, the cost to invest, so we're talking about price of shares, right? Because another decision you have to make is, okay, do I want to invest in Coca-Cola? Because Coca-Cola's been around forever, their stock is going to cost more because we have so much data on how they perform. It's easier to know what your investments might be. People just say Coke. When you say, do you want to drink? They say Coke. They may be talking about brown liquid, but they say Coke. So Coke is such a household name. However, if you say I don't drink soda much, Fanta. So you may be able to buy you may have $100 and you can buy 1 share of Coke, 1 share for $100, or I can invest in Fanta and buy 100 shares for $1 each. And so you're just kind of deciding, do I want to do big shares and ride with the big dogs, or I want to play with the little people? I mean, Fanta's been around for a long time too, right? I've always heard of it. So you just kind of get to decide, do you want to ride with the big boys? So if you do S&P 500, you're riding with the big companies and you're buying smaller amounts of shares. Now, if you do the index funds, the index kind of copycat off the S&P 500. It's not the big dogs, but it's the second dogs. Mm-hmm. And so you can buy more shares of those because they cost less. So I made, who's competing against Starbucks? Like, what's scary? I don't know.
Dunkin'.
Stuff, so I don't know. Dunkin'? Okay, so let's say I can buy $100 and buy, let's say Starbucks is in S&P 500 and I can only buy one share for $100, but in the index fund, they may have Dunkin' Donuts and you can actually get 4 shares for $100. So that's kind of how the index is. It copies, like, okay, you got X number of coffee, I'm gonna do the second guy that has more shares and copy you, but for less money. Does that make sense? Mm-hmm. So you can pick, do I wanna invest in S&P funds or do I wanna invest in index funds? And those are really simple decisions. Individual stocks, S&P index, and then you can go a little bit deeper. You talk about diversifying. So diversifying, I like to say, like, okay, I can have one child and my future's riding on that one child. We're gonna have 5 kids and the future of them taking care of me. I'm rolling the dice with 5. I had 13 kids, somebody's gonna take care of me. So it's rolling the dice in terms of like how much diversification do you want? Like, if I just think I'm gonna ride Apple and I'm just gonna buy Apple or all Apple because Apple is everything and I know I'm gonna make good money with them. Or do I think that everybody's gunning for Apple and eventually, something can happen to Apple and I'm gonna lose all my money. So maybe I'm gonna buy 5 different types of technology stock. Or I wanna invest in 5 different industries. Or do I wanna do 13? So that's what diversification means. Like how many people are you gonna try to ride on and hope that the average of what they do is gonna give you the high return that you want. And it's not as painful as having 1, 5, or 13 kids, but get the point. So then you have ETFs. ETFs are exchange traded funds. Think of exchange traded funds as a basket filled with a variety of assets. So it's just even more, and it's not necessarily like your big dogs, but it's more about variety in different sectors and different types of companies, and it's more of a mix of even like bonds. So let's talk about stock versus bond. So if a company is going to go out of business, they have to pay their stock investors first. Well, no, actually, they have to pay their debts first. So if they owe anybody a loan, they lost money, they filed bankruptcy, but they have assets to sell. They have machines, they have buildings, they have real estate, right? So if you have a bond, you have a debt. That means that person has taken out technically a loan or gotten money from you. So you're first in line when a company goes bankrupt. So it's a greater guarantee that you will get something, but you're accepting a lower return for that safety of being first in line. Versus you're in the back of the line as a stockholder, and that is why stocks are a little bit riskier, because basically you're saying if this company goes out of business, I'm third in line to get money, and they may have given all their money back to their bond people. So that's when you evaluate a company. We also look at debt to income ratio, because how much debt you have is my standing in line to get paid if you were to go bankrupt. Okay? So we're getting a little deeper into more information when you start becoming a savvier investor. So we're going to start small, Cash App, and we're going to learn more terms and get a little bit more aggressive, go deeper into how you pick really good stocks to make better returns. And returns are just profits. Yes.
And you also want to look at that if that company you're considering investing in offers dividends.
Right. Exactly. And that's a good comparison too with your insurance policies. Even when you're picking insurance policies, typically if you have whole life policies, you're earning cash value. So not only the money that you paid for the expense of that policy, ask them, do you just pay, is it just about my premium earning interest, or do you pay dividends in addition? So with insurance policies, whole life insurance policies and stock, you always want to ask about dividends. So dividends is extra money that gets paid on top of returns. Okay? So mutual funds, again, is another way of diversifying. The only thing with mutual funds is that your investors are purchasing a collection of stock, and then your fees associated with the people in the mutual. So you have mutual fund advisors, and those advisors get paid. So then there's a little bit of a reduction in how much return you can have because their annual charges and fees. Unlike ETFs, mutual funds are priced at the end of the trading day and are common choices for retirement plans. So just understand the pros and cons of those. And this is just, again, how deep do you want to go? How much control do you want to have on increasing the opportunity that you can make more money? So we talked a little bit about diversified portfolios already. Who invests? We actually talk about that. The good investor is, you put on autopilot, dip your toe in the water with Cash App, but when you start going deeper into investing money, especially outside of retirement plan, you really want to have your foundation set. Those first 4 steps need to be in play because now you're doing money, and you really just, you need to be able to let that money do what it needs to do and not bother it. And if you are not secure in those other 4 steps, you're not going to be really flexible in your ability to invest properly. Okay? Automate. I just like the government takes money out of your check automatically, you need to make sure that money gets taken out of your check for retirement automatically. Like, there should not be a question. Because you can't control what the government takes out. You should tell yourself, government can take out money with me having control over it. My retirement should come out with me just automatically, not even thinking about it. Okay? That's how deep it needs to be. So